Alright, welcome back to MMG. First of all, not financial advice. Consult your licensed financial advisor. I'm not a licensed financial advisor. This is more of an educational channel. Me sharing my opinions, which could be completely wrong, and learning how to trade, looking at some charts, and yeah, I mean, we're a community at this point where we are highly educated and we're watching things closely economically so we could benefit, right? We're looking for opportunities. All right, so I made a call, probably the most epic call ever, and I said the top's in for the S&P 500. Is it in forever? I don't know. Is it in for this year and possibly 2020? I think so. Can I be completely wrong? Absolutely. But I guarantee you nobody this week or today or yesterday is calling for a top to the S&P 500. But I did it. Now, there's a lot of reasons why I'm calling this, all right? First of all, I know that Wall Street and everyone is hoping that this rally extends past New Year's so they don't have to take profits now, because if they do, then they're going to have to pay capital gains tax on it, right? So they're hoping, this party goes into next year and then they could take profits next month. The other reason is the extreme greed. The index, the fear to greed index, is like pegged to absolute greed. Right now, nobody thinks anything could go wrong. All bad news has been ignored. The impeachment thing, I think the market is priced in that that's not going to happen. Nobody believes it's going to actually happen if you actually pay attention. And I don't think it's going to happen. That's another reason why the market didn't really sell off, but you would think the algos might pick up on the news and start selling, but nope. The repo market, I'm going to talk about that again for a second. Just going to brush over it because the Zoltan thing hasn't really worked out. Not yet, at least. What else? We broke out of that major channel that I've been showing you guys for the past few weeks, right? So this left chart here, this is a daily chart. This is just a 1 hour chart on the right. So I put this line right here at 3,200. The market gapped up this morning, big time, and I'm hoping it'll pull back and on the 1 hourly here, because there is a 9 sell. So if I missed it by what, $20, that's nothing. I still called the top. Now, another reason why I think a pullback and a correction is coming is because we did break out of this major channel, right, on the S&P. And it's not going to just break out and then just keep running higher and higher. It has to retest it. So a pullback or a dip, that's just normal. It's imminent. It should happen. Now, for me to call it the all-time top, right, it has to be more than just a dip or a pullback. It has to at least retest the bottom of this channel and then try to bounce, maybe retest the top of the channel again, but then eventually break down and break out of this channel. Now this channel is pretty significant because it goes back real far back. Now I understand that the price has broken out of the channel quite a few times, but I think if it does it again, it might be it, because there's a lot of parts and pieces moving right now that are that could easily cause a market pullback or correction to be a serious correction. All right. One is the repo market. Two is, longest bull market ever in history. Three is election season coming up. This would be five. What else? Economic data. It's really not that great. Although there is some good news today, but we're definitely at the end of this credit expansion bubble. Now you have to remember in 2008, 2007, 9, 7 and 8, right before the financial crisis, things looked great. Things looked absolutely great, and then all of a sudden, Lehman Brothers, right? A firm goes under, and then things just start snowballing and snowballing. And I've showed you guys other charts of the time correlation, the yield curve, everything, right? The yield curve did invert earlier this year, right? At least 5-6 months ago, something like that. So besides that, there's a whole lot of other things. Unemployment rates at the lowest ever. There's just a barrage, like a handful, a dozen indicators that says we're really close to the all-time high, right? So, and you guys would have been, you would, to understand, you would have been listening to me for at least a year now, because I've shown you guys a lot of things. Now you see this channel. Look how far back it goes. The beginning of the channel goes back to 2009. Now we've tested, the channel, and it's held up barely at times. Back here, when it first broke under it significantly, this was when the Fed raised interest rates for the first time in like 9 years. But then but somehow they put a backstop to it, and the Fed stopped raising interest rates. It did one raise, and then Trump got elected around here, right? And then the Trump euphoria rally, because he's going to cut taxes on corporations and whatnot. And then the Fed starts raising interest rates in 2018, like nonstop. That pricks their own bubble. The market corrects in a big way. 20%, 23% correction. That's a big correction. That's a very decent sized correction, right? If it would have gone any further, then it would have been the beginning of technically a recession. But it didn't, right? Because the Fed stopped raising interest rates, reverse course, capitulated, started lowering rates. And then the market rebound. And now it's been going higher and higher on tweets, the trade talks, and the algos buying, and even the repo market has affected the market positively, because a lot of that liquidity goes back into the market because they're liquefying the banks, right? They're basically bailing out the banks right now with the repo market. And I'm going to talk about that as it relates to the dollar. So my last video was the video prior was the milkshake theory video. Very good video. Watch that if you haven't. And the milkshake guy said that foreign hedge funds, banks, entities, you name it, they all took out a ton of loans in dollars because the dollar's world reserve currency. It's been the strongest. And they all were betting that the dollar would lose value in the coming years. So far, it hasn't. The dollar has been the strongest in the past few years since Trump got elected. And that has started blowing up their banks. They're having liquidity crises. China needs like a $400 billion. They have like a liquidity crunch. They need $400 billion in dollars to save their own banks that are starting to go under. There's a rumor that another big one went under in China. Now you have to understand that all of these banks now globally are pretty much internationals. They're all intertwined. They all use, most of their reserves are in dollars, and that's the problem. Okay? So the repo market may have been caused by Chinese banks or other banks, maybe Brazilian, I don't know yet. And if one of them goes under, it might, through third counterparty risk, one of the major U.S. banks might get in trouble, right? Because it's all intertwined now. This entire credit bubble is global. That's why it's the everything bubble, not just for the U.S., but for the entire globe. Because the dollar is the world reserve currency, and the Fed has to keep creating credit. Credit is what? Dollars. All right. And what is credit? Debt plus interest. All right. So I think that, let's go to a dollar chart so I can think better. Where is it? Why? So, that's not it. Where's my markets chart? Markets. Okay, so here we go, US dollar. Let's go to the dollar real quick. This is important, so pay attention. So the milkshake dollar theory thing says that all these banks internationally, they need dollars because their debt is denominated in dollars. They can't default, but if they do default, well, they can, I guess, then that would actually cause less demand for dollars, which would actually make the supply go down of dollars, because when you default, the money literally vanishes, poof, into oblivion. And then the supply of dollars drops. And to prevent all these defaults, my theory is the Fed is like the central bank of the world at this point, because they have to keep printing. If they don't, then not only are U.S. banks in trouble, right? Because of the overnight lending, because they don't trust each other anymore, probably for a really big reason, because something broke. It's because doing the repo market and injecting liquidity into U.S. banks in a way injects liquidity and cash into the entire global market, and that cash and liquidity is maybe lent out some more to the global market, essentially, to like maybe Chinese banks going under, or Brazilian, or any of the pigs nations, Europe, I don't know, Deutsche. Essentially, that's what happens, that they probably didn't anticipate on because they're stupid. That if they create a giant credit bubble and do QE after 2008-2009 financial crisis, not only do they create a bubble for the US, but for the entire world. And there's actually more dollars outside of the US than inside. And to service all of that debt, the Fed has to keep expanding the currency supply in perpetuity forever, because it's all credit, right? There's interest on all the dollars ever printed, and it's gone global. So the Fed's trapped in a really bad way. Like, if they don't meet the liquidity demand and the demand for dollars because of all the outstanding debt globally, then we get a global depression. If they do meet it, their balance sheet is going to explode, which the markets can't ignore that forever either, and then the markets fall anyways, and the bond market blows up, meaning the bond market's like, hey, this debt is beyond we can't even service the interest on the debt for all these bonds and treasuries, and then the yields someday will just explode and spike. Like Paul Volcker came back from the dead and like started running the Fed, and that's the problem with a globalized Ponzi, essentially. That's what I'm saying. So this repo market problem, it's not going away. By the way, this is a daily chart of the dollar. Again, so deflation or inflation, it's not that simple. It's never that simple. I think right now, for the short term, we're going to see deflation. Well, the dollar is going to fall versus other fiat currencies, maybe to 95 handle. But then as emerging markets, second world, China, and the rest of them, in their firms and their banks start defaulting on all of their dollars, there'll be a rush to safety to the dollar, and two, the demand for dollars will drop, which is the milkshake theory. So very short term, maybe we'll revisit the 95 handle. Midterm, which is next 6 months, couple years or something, the dollar might actually strengthen. Long term, it's going to blow up because the Fed's going to just keep printing because it has no choice. Unless they just, if they don't, then the system, either way, is going to blow up. It's just, if they keep printing, that just buys more time, and that's probably what they want. Again, everyone's scared to death. They're probably scared. They know what's going on. To some extent, they know what's going on. They're probably scared to death. So they will just keep doing that and buy more time. Also, we just had Trump tweeting for QE. Literally. It's nuts. Anyways, it doesn't matter what the dollar does. Gold and silver is going to go up. So if you look at that chart, again, it's just consolidating, guys. That's all it's doing. So here's gold. Silver is actually stronger right now. It's above 17 and staying above it. By the way, cyclically, there are seasonal things that go with metals. We're about to go into like the most bullish time for metals seasonally. There's an article on that. All right, so let me talk a little before I'll end it with the gold and whatnot. But again, my website, 15% off. The link is below this video in the description. So 15% off for 2 more weeks before the party gets started. All right, so the Zoltan article, right? Well, so far it hasn't really come true. It looks like the year-end repocalypse that was predicted by Credit Suisse strategist Zoltan is taking a rain check. I'm just going to read some of the stuff in here. So, as such, for the second day in a row, the Fed's term repo operations was undersubscribed, but was notable about today's temporary liquidity injection is that this was the first term repo since the start of the Fed's emergency repo program that covered. So these term repos are the Fed's gonna give them weeks and months to hold on to the cash, basically, before they have to return it for a very tiny percentage fee, right? Interest. Now, you know what's gonna happen? I guess you can't default when there's a rolling, never-ending cycle of rolling liquidity injections of repo, right? So, the bank gives back the repo, and then they'll just take it out next week, and they'll just keep doing this forever. Now, the thing to watch is, they could probably pull that off for quite some time. I don't know how long. Who knows how long? And it could become like this new norm where the Fed just keeps injecting billions and billions, and the banks will take the repo, they'll take the money, and then they'll give it back a few weeks later or a month later, something like that. And not just that, you have to watch these term repos, are they being extended time wise? They keep getting extended. This is definitely going to be an ongoing long term thing. Now the thing that you would have to watch is what gives away that this is basically QE4 and bailing them out is the balance sheet of the Fed, right? If it just keeps expanding, we just hit like 4.15 trillion. And I mean, the market and the bond market, they can't ignore it. At some point, everyone's going to say, hey, what is really going on? Is the Fed literally just injecting trillions into the banks to keep them afloat? But they're saying it's not QE because they roll over after like a few weeks or a month, and then they just do it again, because it's a never-ending like turnstile, right, of cash flowing in, flowing out, flowing in, but it's just keeping the banks afloat, right? It's keeping them from possibly, who knows, defaulting. I don't know how their balance sheets look, or they haven't reported yet. They will report in the first quarter, so maybe we'll be able to see who's in trouble. As such, it now appears that the banks finally have their fill of what they believe will be sufficient year-end liquidity, and all subsequent turn. Repos will likely see a lower allotment as the Fed's $500 billion liquidity backstop bazooka ends up being underutilized. So as of right now, it looks like they stopped taking the full cash that the Fed's offering them. They're only taking parts of it as of this week. And it doesn't look like anything blew up just yet. But we'll see, right? The Fed took out the bazooka last Thursday and proposed to flood the repo market with liquidity if needed. That's the catch. The primary dealers might not take all of the cash the Fed is offering. Either way, they won't need it or they won't want it. So there are two scenarios as we get close to the end of the month. Either primary dealer banks do not take all of the Fed cash because their balance sheets are full, or because they don't need the cash. Wrightson estimates that only $300 billion to $350 billion of the $500 billion. $500 billion is, guys, that's half a trillion. $500 billion will be taken by the primary dealers. We could see whether the Fed repo ops are oversubscribed or undersubscribed by watching the results back on November 25th. So by the end of this month and year, we're going to see if they use up all the $500 billion. If they do, then things are heating up and getting worse and worse. If not, then people are probably going to be less worried. Either way, I don't even think most people care about this yet. They just believe what they say. Like, this is a temporary thing, no need to worry. Here's some other articles I talked about recently. Morgan Stanley, it's fair to say that the market rally is due to the Fed's QE. Remember that? And some of that is going probably into the market, which is insane for me to call an all-time top as that's happening. So I am, So if I'm wrong, I'm just wrong. And I guess people could make fun of me, say I was wrong. But if I'm right, I probably won't become famous, but I should. Because nobody else would call it to the day, or to the week at least, or within a few weeks, right? But if I get this right, I could at least say that I did that and nobody else did. The Zoltan dude would get well, that's only if the repo. So, I probably wouldn't become famous, but I could always say the rest of my life that I called the top. And by the way, even if I called the top for this year and next year, that doesn't mean that it's all that if they do keep doing QE, they might cause a huge melt up in the stock market. Although it's too early to tell if that's even possible. I'm just saying that. But if we do get a huge correction going into 2020, I think the probability of making new all-time highs ever again will become slim. All right. So, what else do we have? So, the BIS. Let's take a look at this article. Bank of International Settlements. Well, I already looked at them. I mean, they said that it was mainly because of currency swaps in the currency markets and hedge funds and banks levering up, with currency swaps betting that the dollar would be weaker. And that hasn't happened. And that also put a lot of hedge funds and banks, they probably lost a lot of money, causing the repo market turmoil, which affects the U.S. banks because of they probably gave out loans to these foreign banks and countries. I don't know, guys. It's all so intertwined with the credit derivatives and all of that. However, the BIS said that while those two factors helped explain some of the problems, they fall short of the full accounting. None of these temporary factors can fully explain the exceptional jump in repo rates, the bank wrote. So these currency swaps, what they did was shoot the federal funds rate. Okay, so it's complicated, I know. When the Fed reversed their interest rate hikes to cutting rates, that caused a spike in interest rates, that triggered possibly currency volatility and turmoil, and may possibly had a bunch of banks internationally and US maybe, or Europe, I don't know, they got wrecked basically. and that's being papered over by the repo market, and nobody knows who's in big trouble. Deutsche Bank, everyone knows they're in trouble, and they probably got wrecked as well. We'll see. We'll find out. So I don't want to talk about this too much anymore. All right. What's this article? Right. So artificially low yields and interest rates, they're keeping the current environment going, right? The market's going up. All these corporations and firms, they could afford all of their leveraged bets and long positions and all equities. It's also created this weird dystopia where people buy bonds betting on the fact that the bond's value itself is going to go up, not so much for the yield. And they view bonds as growth stocks versus equities as growth stocks, because equities are just so overvalued, and the market cap of the entire equities market, like, guys, it cannot keep going up. It takes more and more capital in perpetuity compounding to make the price go higher. So when the market cap of, I don't know, equities is 20 trillion versus 80 trillion, it takes all that much more money to make the price go higher from 80 trillion than from, let's say, like 20 trillion. Do you understand? Anyways, yeah, so let's go take a look at some more news. This is interesting. On a side note, climate change and all that, right? I never said that the climate's not getting crazier, because it maybe is. I don't really know. We have more, media now, videos, and news, and the internet to be able to know about extreme climate changes, right? I know some scientists could look at historical data, but it probably doesn't go back that far, to be honest. For humans to understand the cycles of the weather changing. But the one thing is true, that the pole, the north, is moving. And that would definitely change the climate on the planet. All right, so it's not man-made. It's cyclically the poles flip. every, like, I don't know how many thousand years or something. And I know we're overdue for one. And the North Pole has been moving like a lot. It's abnormal. Like, look at this chart. I mean, I'll post this in the newsroom. Links in the description section below this video. All right, so 9,300 stores, retail stores like clothing and shoes, has pretty much closed this year alone. Does that sound like a booming economy? Not really. Oh, but it's because of Amazon. Yeah, they probably have a, the online shopping definitely has an impact on that. But and they're putting up huge warehouses everywhere. But then again, why is FedEx shipments going down? It's not like Amazon's shipping everyone's goods yet. They plan on to. But where was I going with this? Either way you look at it, people are still shopping, but it's maybe they're not shopping as much or buying more name brand items. Or listen, 9,300 stores. That's a lot for 1 year. And this has been going on for years now. For like 4 or 5 years. In the greatest economy ever, right? Final third quarter GDP revised unchanged at 2.1%. So the GDP, it's not worse. They didn't revise it down. So everyone's like ecstatic. Although it's only 2.1%. And I guarantee you it's less than that if you adjust it for inflation in reality. But, no one looks at that. They only look at headline numbers. But, the strongest season... Hold on. But, there's another article. I will admit that U.S. personal income has started growing. As of recent. Now, it's grown since 2016, but it took a dip in 2018, and now it just ticked up a little bit towards the end of 2019. So people are maybe getting raises and bonuses. And that's good because you need wages to outstrip inflation. Is this going to be long-term and sustainable? No way. You will see wages go higher, but it's not going to keep up with inflation. You're going to see that in the coming years and decade. So what I'm trying to say is you do always see a little bit of wage inflation, right? Which is you get more pay, you get raises, right? Towards the end of economic cycles, boom cycles, bull market cycles, people always, towards the end, everyone's euphoric. Businesses think we have another 5 years or something, who knows, of economic boom, and they decide to give everyone a little bit of a raise, and then there you go. So you always do see that towards the end of cycles. So I wouldn't take it too seriously just yet. Because listen, we're not making manufacturing jobs, and here's the proof of that. U.S. Steel shares plunge, buybacks halted, 1,500 workers cut amid deepening manufacturing recession. Like I said, manufacturing is the real economy. It's not people serving beers and donuts and serving food at restaurants, or all these little shops I've noticed have popped up everywhere. Like donut shops, this shop, that shop, cupcake shop. But those types of businesses, they don't really produce anything in the essence of, and they don't export anything for the country as a whole, right? Manufacturing jobs do. That's what the U.S. became the strongest and richest country in the world because of the Industrial Revolution. And we've been living off of that teat ever since. But we're coming towards the end because now we're at the end where the manufacturing country of the world turned into a financialized service sector, consumer-based economy, which is absolutely unsustainable because we export nothing but debt. Hence, the dollar repo problem right now. We exported a ton of debt. So now we got to keep the global Ponzi financialized system going too. You guys starting to see how the puzzle pieces are coming together? The biggest thing the U.S. exports is dollars. And someday, when everyone starts defaulting or just abandons it, it's all going to come back. The problem is there's no, to the dollar, there's nothing that can replace it. The world reserve currency in the end is just going to be gold. So maybe a basket of gold, silver, and Bitcoin. I don't know. We'll see. Either way, I'm bullish for all three in the long term. Let's get back to what I'm trying to talk about. Here's another indicator. Germany is already in a recession. Their industrial section, their manufacturing section. And Germany has a huge industrial base. Largest one in Europe. That's why they have the strongest economy in Europe, right? Germany has the strongest economy in Europe, has the largest manufacturing and industrial base. Proves my point that I was just talking about. But they've just recently got into recession, which is eventually going to ripple over here, like dominoes keep falling. The U.S., the cleanest shirt in a dirty hamper, right? In a basket of dirty clothes. So what else have I skipped? It's pretty much it for now. And I think today released was the Kansas City Fed composite, but the business survey's at its lowest in 4 years. So, also, equities are on a 7-day winning streak. So I know someone's going to comment, oh, your call's going to be wrong. We're going to find out soon enough. As of right now, I'm not wrong yet. So let's see if I made the most epic call in like financial history. Because if it's the all-time top forever, and I called it to the week or day, or let's say even to the 2 weeks or month, I could put that on my gravestone or something and be known for it. Hopefully someone would write an article about me or something. That'd be really cool. If I call it right. So far, I'm not right yet. We'll see. Anyways, let's take a look at gold again. Should I take a look at Bitcoin? Nah, I'll make a separate video. Why not? So, pulling up a gold chart here. Wrong one. Listen, guys. Oh, that's the article I want to talk about. So, seasonality for gold is the highest coming up next month. And gold has not fallen. Its low was 1446, and we already bounced back up from that. Will we go below 14? I don't think so, because the seasonality is coming up. India, Asian countries, they start buying, and it's just the season historically for precious metals to rise, as they always do. And besides that, then there's everything else, right? The balance sheet of the Fed, Trump tweeting for QE and lower interest rates, the stock market, if it does correct as I am predicting, that should also boost metals, because then everyone starts anticipating more rate cuts and QE. And then metals, and it's a safe haven bet, right? It's the only undervalued asset compared to everything else, bonds to equities. Now, I understand that metals have hit all-time highs in foreign currencies. It hasn't in the U.S., but I'm speculating it will as well soon. And if you look at this is a chart of gold. It's 6-hour chart. Let's take it to a daily chart. Besides the fact that this looks like a bull flag, and it's actually breaking out, and we have a cup and handle, this is all consolidation. All of this right here. It's consolidation. There's definitely buying going on. The smart money's buying, while everyone is chasing the last 10% on the on equities, right? So we are coming up on a 9 count in the next 2 days, trading days, which would be Monday and Tuesday next week. But if the market falls, I don't care. The price of gold will break above 1,500 major resistance. If it breaks above 1,500, it's good. I think it's gonna run higher and make a new high, right past 1566. That's what I'm betting on. The 3-day chart and the weekly look more bullish than the daily. Here's the 3-day chart, right? So we did have a 1, 2, 3 count with the TD, which is very bullish because that means we're going to get a 9 count to the upside. Right now, the 4 and the 5, are lagging a little bit, but that's normal in the 9 count to the upside. The 4 and 5 usually do have dips, and then we get a 6, 7, 8, 9, 4 more candles of upside, which would take us into the end of the year, breaking above 1,500, and then we'll see where we go from there. All right. But as of now, I'm still bullish, still holding long, and it'd be awesome if gold could break above 1,500 by year's end. So I could hold my long position and then take profits next year versus this year for obvious reasons, right? So I don't get hit with capital gains. All right. So still bullish here. On the weekly here, I really do need this week. It would be better if the body of this candle would go above 1492. But it's okay if it closes anywhere above 1480 this week today. So today is Friday, right? It's the 20th, and the market hasn't closed. It's 1 p.m. U.S. Eastern Standard Time. So you guys know. Let's take a look at silver real quick while I'm at it. Silver's looking strong, guys. Look at this. The chart of silver looks even better than gold because it bounced off the 200-week moving average, and it's now heading up, and it's above 17 bucks again. And if it could get back above 17.4, then I'm pretty confident we're going to go test $18 again. $18 is the equivalent of, I would say, $15 for gold, or $1,500 for gold, major resistance, right? Either way, silver looks bullish and it could drag gold up. Also, there's open interest on gold and silver. There's so much money shorting it. If the prices literally just go up a little bit, another 5-10%, those shorts are going to get squeezed, which will act like rocket fuel for the price and might shoot it up 20-30 bucks for gold, and maybe shoot us up past $18 on silver. All right, guys. 15% off. Go to my website. Links for everything is in the description section. And smash them likes. Leave questions or anything, comments in the comment section. I will answer them and read them. And smash them likes. Share my videos. Only way my channel grows, and I will continue to do this. Until next time, guys.